Shopping for a mortgage feels like learning the rules of a weird board game. You've got all these pieces, a bunch of confusing terms, and a nagging feeling. Someone, probably the bank, is about to yell, "Gotcha!" and take your properties. You see interest rate APR thrown around. Similar, but not the same. Like two twins at a party, you're too polite to ask which is which. Let's clear the air. Understanding these two numbers is the key to not overpaying for your home. Buying a home without knowing the difference between APR and interest rate is like ordering pizza and only asking the price of the cheese. Cheese dough sauce pepperoni, that weird delivery fee. $15 pizza suddenly costs $25. Where did it all go wrong? Interest rate is the cheese, APR is the price of the whole pie, delivered. APR is the all-in cost, knowing it separates savvy buyers from surprised ones. I'll pull back the curtain on this financial magic show. We'll break these terms down simply so you can explain them at your next barbecue. No more nodding when lenders talk percentages. By the end, you'll be in the driver's seat. Let's start with the star of the show, the number everyone talks about, the interest rate. This is the figure you see advertised on billboards and in flashy online ads promising an unbelievably low monthly payment. In the simplest terms, the interest rate is the percentage of your loan amount that the lender charges you each year for the privilege of borrowing their money. It's the direct cost of the loan itself, without any of the extra bells and whistles. Think of it as the price tag on the money you're borrowing. If you borrow $300,000, the interest rate is the fee for renting that cash. This number has a direct and powerful impact on your monthly mortgage payment. A lower interest rate means a lower monthly payment, and a higher interest rate means a higher one. It's that straightforward. For example, let's say you're looking at a $400,000 loan. With a 6% interest rate, your monthly principal and interest payment would be about $2,398. But if you snag a rate of 5.5%, that payment drops to around $2,271. That's a savings of $127 every single month. Over the course of a year, that adds up to more than $1,500, enough for a nice vacation, a serious upgrade to your living room furniture. This is why the interest rate gets all the attention. However, focusing only on the interest rate is a classic rookie mistake. If the interest rate is the celebrity rock star, then the annual percentage rate, or APR, is the rock star plus their entire entourage. The manager, the publicist, the stylist, and that guy who just carries the bottled water. The APR gives you a much bigger, more complete picture of what you're actually paying. It starts with the interest rate and then bundles in a bunch of other borrowing costs and fees. These can include loan origination fees, discount points, which are fees you pay up front to lower your interest rate, mortgage insurance, and some, but not all, closing costs. It's the true all-in cost of your loan, expressed as an annual percentage. Why does this matter? Because two loans with the exact same interest rate can have wildly different APRs. Imagine lender A offers you a 6% interest rate with $8,000 in fees. Meanwhile, lender B also offers a 6% rate, but with only $2,000 in fees. On the surface, the monthly payments look identical because the interest rate is the same. But the APR for lender A's loan will be higher because you're paying a lot more in fees to get that loan. The APR is the great equalizer. It helps you compare apples to apples by converting all those upfront fees into a single comparable percentage. The government actually mandated the disclosure of APR with the Truth in Lending Act for this very reason. They wanted to stop lenders from hiding costs and advertising a super low rate that was only achievable after paying a mountain of fees. Let's step away from finance for a second and talk about something we can all get behind. Tacos. Imagine you're trying to find the best taco deal in town. You see two taco trucks parked across the street from each other. Taco truck A. Tacos. Only $2 each. That sounds amazing. That's your interest rate. The simple, advertised price. You're ready to run right over and buy a dozen. But here's where it gets interesting. You walk up to taco truck A and place your order. The owner says, "Great, that'll be $2 per taco plus a $1 plate fee, a $2 salsa fee, and a $3 napkin convenience fee." Suddenly that $2 taco actually costs $8. The advertised price was just a fraction of the total cost. Now, Let's check out Taco Truck B. You walk over and ask about their $2.25 tacos. The owner smiles and says, "Yep, $2.25 gets you the taco, the plate, all the salsa you want, and a whole stack of napkins. No extra charges." In this scenario, the total all-in cost of the taco experience is clear from the start. This is your APR. It might have looked a little higher at first glance, but it represents the true total cost. If Taco Truck A were forced to advertise an APR, their sign would have to say something like, "Tacos. Total cost is $8 each." By now, you've probably figured out why the APR is almost always higher than the interest rate. It's a simple matter of addition. The APR calculation starts with the interest rate and then, sprinkles in all those other delightful costs associated with getting the loan. Since you're adding positive numbers, the fees, to another positive number, the result is naturally going to be bigger. The only time the APR and interest rate would be the same is if the loan had absolutely zero fees, which is about as likely as finding a unicorn grazing in your backyard. Lenders are businesses, after all, and these fees are how they cover their operational costs and, well, make a profit. Think of it like a concert ticket. The ticket might have a face value of $75. That's your interest rate. But by the time you check out online, you've added a service fee, a facility fee, and a convenience fee that's anything but convenient. Your final cost is $95. The APR is that final $95 price, converted back into a percentage to show you the total cost relative to the loan amount. The difference between the interest rate and the APR, that gap between $75 and $95, represents the total impact of all those extra fees spread out over the life of your loan. A larger gap between the interest rate and the APR is a major red flag. If you see a loan with a 5.5% interest rate and a 6.5% APR, that 1-point difference signals that the loan is packed with fees. In contrast, a loan with a 5.6% interest rate and a 5.75% APR has much lower fees associated with it. All right, so we know these two numbers are important, but where do you actually find them? Thankfully, they aren't hidden in some microscopic font. Federal law requires lenders to provide a loan estimate, a standardized 3-page document, within 3 days of applying for a mortgage. This form is your treasure map. It lays out all the key details in a clear, easy-to-compare format designed specifically to help you avoid confusion and compare offers. Think of it as the nutrition label for your mortgage. Your first clue, the interest rate, is right on page 1 front and center under the loan terms section: loan amount, interest rate, projected monthly principal, and interest payment. To find your second clue, the APR, flip to page 3. Look for the comparison section. You'll see the APR listed clearly. The form explains your costs over the loan term expressed as a rate. The section shows how much you'll have paid in principal, interest, mortgage insurance, other loan costs in the first 5 years. Having these numbers on different pages is a subtle but brilliant design choice. It forces you to look at the whole document and separate the two concepts. Page 1 = monthly payment. Page 3 = total cost. A smart borrower looks at both. Now that you're armed with this knowledge, let's talk strategy. How do you use this information to win the mortgage game? First, always compare at least 3 different loan offers. Don't just go with the first lender you talk to or the bank where you have your checking account. Getting multiple loan estimates is the only way to know if you're getting a competitive deal. Once you have them, don't just glance at the interest rate. Create a simple chart or lay the documents side by side and compare the APRs. The lowest APR is usually your starting point for the best overall deal. If you see a big difference between the interest rate and the APR, put on your detective hat. Go to page 2 of the loan estimate, loan costs and other costs. This is where the lender lists every fee: origination charge, appraisal fee, title insurance. A high APR is caused by high numbers in these columns. Are they charging excessive points? Is the underwriting fee double another lender's? Question everything. Sometimes fees are negotiable if you know they exist. Pro tip: consider how long you'll stay in the home. If you might sell or refinance in a few years, a loan with slightly higher interest but very low upfront fees, and thus a lower APR might not be the best choice. You might be better off with the lowest possible interest rate to maximize monthly savings, even if it means paying more in fees. APR assumes you'll keep the loan for the full term, spreading upfront fees over 30 years. Feeling a little overwhelmed? That's perfectly normal. This is complicated stuff, and sometimes you need a guide to help you navigate the terrain. When you're looking for a mortgage expert who can cut through the noise and give you straight answers, there's one name that consistently comes up: Kris McCullough. Kris isn't your typical loan officer. He's a retired U.S. Marine, duty, integrity, mission-focused determination. He's the owner of the KDM Team, a premier mortgage brokerage. His motto isn't just about closing loans, it's about serving people. Kris has built a legendary reputation for funding the loans that other lenders won't touch. He and his team specialize in finding creative solutions for complex situations. Self-employed with fluctuating income, have a few dings on your credit report trying to buy a unique property. While other lenders see problems, Kris sees a challenge to be solved. He understands that life isn't always a straight line, and he believes that everyone deserves a fair shot at homeownership. He's the guy you call when the big banks have already told you no. So there you have it. The great mortgage mystery is solved. The interest rate, the simple, sexy number. It determines your monthly payment, the APR, the more responsible, all-inclusive sibling. It shows the total cost once you factor in fees. Remember the taco analogy. Don't be lured by the cheapest-looking taco. Ask about the plate fees. Ask about the salsa fees. Ask about the napkin fees. Compare the APR on different loan estimates. You're asking for the total, out-the-door price. This simple step can save thousands, even tens of thousands. The difference between a good deal and a deal that just looked good. Your future self, happily enjoying your new home, will thank you. Buying a home is the biggest investment most of us will make. Spend a little extra time understanding the fundamentals. Don't let the jargon intimidate you. You now have the knowledge to analyze loan offers. Ask intelligent questions. Negotiate from a position of strength. Now, who wants tacos? On me, after we check the APR.